All right, we are live. Thank you so much for joining me. I'm Mitch Goldberg. We're just getting started. This is my live stream, Be the Boss of Your Money. It's all about you. It's all about helping you become the best financial, or I should say, the best version of your financial self. We talk about financial literacy. That includes investing in the stock market, the economy. And what are you doing, by the way, to get prepared if the economy does in fact go into recession, layoffs in fact do rise, and you find yourself with job insecurity, or worse yet, out and out looking for a new job. We're going to talk about that. We're going to talk about the debt ceiling. Guess what? We hit it today. That's right. Today, we are now in debt ceiling territory. It's a weird thing. And if you didn't know about it, I'll tell you all about it, what it means. And I don't know, Netflix, Nordstrom. There are so many things to talk about today. So I'm going to roll with it right now. While you're watching, if you wouldn't mind, give us a thumbs up. It really helps spread the word about the good work we're doing here. And it's all financial education, no infomercials, no sales. We want to teach. That's what we love to do. That's a passion of mine, by the way. And if you want, ask me a question in the comments. I love hearing from you. It's the best part about doing this, actually, is seeing your comments. So say hello. Let me know where you're watching from. Ask me a question, or just share with me your favorite emoji. And I'm going to get rolling with the intro. And we're going to have a very good, peppy show. Here we go. All right, thank you so much for joining me. So let's do this. Since Jay is with us, Jay, his comment: don't we always hit the debt ceiling? Seems like it happens with every administration, and it does happen with the last bunch of administrations, and we always get through it. And by and large, it's a scary event. I think it was, what year was it? The was it S&P downgraded U.S. debt from AAA to AA, the first time that's ever happened. That was probably, I'm guessing, about 10 years ago. Okay. And the stock market took a pretty, if it maybe it was sooner, but the point is the stock market took a serious plunge, and we got over it. Nobody really talks about it anymore. And I think the reason, oh, wait. Okay. Jay says it was, oh, wait. So was it that long ago already? My goodness. So 15 years ago. I can't believe it's been that long. Just time is running. By the way, that is such an awesome profile picture on Facebook of you and Robin. Love to see it. The happy smiles. So we are in debt ceiling territory. What does this mean? I have my notes here, so I want to make sure I do this carefully, because I think when you hear all these buzzwords and default and bond issuance and downgrade, um, I think what happens is we get lost in the details, and we walk away a little more confused than actually cleared up on what the debt ceiling means. So the debt ceiling means it's about paying for things that we already spent money on. It's not about paying for the following year or well into the future. It's about paying for, we borrowed to buy stuff, and now we're paying it back. It's kind of like when people have debt, a credit balance. They have a balance on their credit card, and it's not for stuff that they're going to buy in the future. It's because they bought stuff, vacations, TVs, whatever electronics in the past, and now they're carrying that debt. And if they want to buy new stuff, they have to go into more debt. But think of it this way: if your credit card is maxed out, you can't buy new stuff. Now, as consumers, we know, then you just say, don't buy new stuff. And I'm not knocking people who are literally at the ends meet of survival, of maybe not surviving if they can't borrow a little bit more. I'm not trying to be uh, I'm not trying to be insensitive here to people who are in dire straits. Just want to get that straight, okay? So, but when the government hits its credit limit to borrow money for the things it needs today, it has to raise its credit limit, meaning it's the debt ceiling. It's the same thing. So, how does this happen? We need a Congress to approve it. And if Congress doesn't approve it, then we can't issue more debt. And that debt is actually for things that we already paid for, like salaries for military personnel, contributions to government employee retirement programs, postal service, Social Security, Medicare, uh, everything. And this affects our way of life. And I know that there are those out there who are saying, no, no, screw it, let's default. We shouldn't be paying for these things or it's too much. And there are those people who say this is financial suicide. You've got to keep paying because one of the things that also might not get paid is the interest on U.S. Treasury securities. That's never happened before. That would be a default. We have never defaulted on debt. The U.S. has never ever defaulted on debt, and as a result, the United States Treasuries are the safe haven security of the entire world. And as Americans, we get a lot of benefits from that. We have perpetually lower interest rates than if we did not have the main safe haven treasuries. If treasuries were not the main safe haven of the financial world. The United States has liquidity. The United States has a strong dollar. Yes, I know the dollar sometimes gets weak lately. It's been strong, getting a little bit weaker, but it's been strong lately. But what I mean is, it's the U.S. dollar is a reserve currency. If we default on the debt, it doesn't mean the U.S. dollar won't be reserve currency, but it'll lose its status as reserve currency by a good amount, maybe even completely. Okay, not overnight, but we will get there, and it'll accelerate it. Believe me, China would love to see their currency, the yuan, or as they say, the renminbi, as another competing world currency. That would be detrimental to the United States. Maybe oil is traded in dollars. Maybe oil will be traded in other currencies. That wouldn't be good for the U.S. dollar, and by extension, we as Americans would lose financial benefit by losing that status. So what else? Let's talk about this. So the Treasury Department, which is responsible for taking money in through the IRS. The IRS is part of the Treasury Department, and then the Treasury Department pays the bills and issues debt. Okay, when it issues debt, it issues Treasury securities, Treasury notes, Treasury bills, also known as T-bills. So the Treasury, Janet Yellen, the Treasury Secretary, is taking extraordinary measures. She wrote a letter to Kevin McCarthy, Speaker of the House, leader of the House of U.S. Representatives, and said, we are now taking, as of today, extraordinary measures to make sure that we pay our bills and fund our obligations. Please get to an agreement on the debt ceiling as soon as possible. A default on U.S. Treasuries would have wide-ranging implications on our economy and the stock market, and day-to-day things like Medicare, Social Security would be affected, or could be affected. It depends on how long this goes on, but it's pretty much agreed that the Treasury will easily be able to pay its bills of the U.S. government through June. Okay, so that is to buy Congress a little bit more time. Of course, it really stinks that Congress always gets to this point last minute. I mean, today is the day we hit the debt ceiling, so we should have been working on this months, if not years ago. But, it's a tough thing to deal with, so we wait till the last minute, and here we are at the last minute trying to do some horse trading. Some of the horse trading that I hear going on that could affect you, whether if you are under 60, under 65, 67, or over. This affects everybody. One thing that the Fed could do is raise what's called the full retirement age of collecting Social Security from the age of 67. If you were born after 1950 and beyond, your full retirement age for Social Security purposes is 67 years of age. That probably is just pretty much everyone who's watching me right now. They want to, maybe Congress could raise that to 70. So that will be, people will say, well, that's a cut to benefits. Or people could say, well, people are living longer, so they should collect Social Security later in life, or at least the full retirement age amount later in life, because they're living longer. We have to account for that. And that'll help keep the program solvent for many, many more years. I have to say, I don't think that's the worst thing. That would affect me. I'm 55. So, I'm looking forward to collecting my Social Security, but now instead of waiting till 67, 12 years, I'm going to have to wait an extra 3 years. So I've got 15 years. So that affects me, but I'm not opposed to it. I'm not opposed to that. I know I'm going to get some flack for saying that, but I'm not. By the way, Jay says we are old. We're not that old. Come on, 55. I mean, look at me, man. I mean, look at this. Do I look old to you, man? Who you calling old? All right. What does Jay say? I love this. It's like the doorman strike or sanitation strike. Always gets resolved in the final hour. That being said, it took 15 times to elect a speaker. We might be in a new paradigm. Well, we might be, but things don't happen until they have to happen. I suppose people could try to make things happen. And supposedly, this is what I've been reading, that part of McCarthy. Hold on. I'm going to take a screenshot of, well, I don't want to mess up the show, but I should take a screenshot right now. Rockstar. Thank you. Thank you. So, thank you. So, Speaker McCarthy's part of his deal to get enough votes to become speaker, said to the group of 20 that was holding out and electing him, voting for him, he said that he would look at Social Security, Medicare cuts to get an agreement on a debt ceiling resolution. Medicare, you can collect that. You collect it when you're 65. Maybe he'll raise that. They'll raise that to 66, is what I read today. And again, I don't think that would be so terrible. We are living longer. These are valuable programs. They're expensive as hell. And maybe, raising the ages is not a bad thing to do. Again, that I know that would affect me, but I would agree with that. I don't want to cut disability to people with disabilities. There's a few things I would be opposed to, but those are good places to compromise on. Maybe I don't know if that's enough. I don't know if allowing those to happen, raising the age for full retirement age for Social Security and for Medicare, is enough to get a deal over the finish line, or do we just say the Democrats are going to say, well, Republicans in Congress, not all Republicans in Congress, do you want to be the party that defaulted on the debt? Do you want to be the party that plunges our economy into the depths of hell, crushes our stock market, and ruins our economic standing in the world order permanently? Do you want to tell the seniors in your districts that their Social Security funds are not going to be hitting their checking accounts because of them? That Medicare will not be paying the doctors to take care of them? Do you want that on your head? So the White House said they're not negotiating based on cuts. They said we'll do a straight thing. We'll clear the budget resolution. To raise the budget limit, the debt limit rather. We'll raise the debt ceiling, but it should negotiations on entitlements and other areas that could be cut. Those are separate negotiations. But Republicans in Congress will say, this is the only leverage we have, because we know once we raise the debt limit that you're never going to give us a shot again to lower or to change entitlement programs to make them more solvent. So it's a really tough position. And as usual, we are in the middle of it. And we could argue whose fault it is. But I'm going to tell you, I'm on your side, whatever side you're on, because we're all going to feel it together. We all have to agree, and we've got to make this work. Okay, so what else? The Treasury could make cuts to certain things. They could do a debt. They have to stop issuing more government debt, but the Treasury could get its hands on money using accounting tricks, gimmickry methods, tools, whatever. It could stop reinvesting debt in the U.S. General Fund. It could stop reinvesting in new securities in the government pension plans for government workers. Okay. The Federal Reserve could actually purchase bonds, more quantitative easing, which would be the equivalent of printing money. So the Fed could do that if need be. I think the Fed is weary of doing that because it's worried about inflation. But if the economy is plunging because of a debt ceiling debt ceiling because of a because we don't pay the bills, because we default on our national debt, I don't think the Fed's going to have to worry about inflation. I think they're going to have to worry about the emergency in front of them. All right. So let's talk about a few other things. Nordstrom came out after the close and it said that they are lowering their financial forecasts for 2023 because of weak holiday sales. That's a pattern. We're seeing that across the board in apparel type retailers, Macy's, et cetera. What this is all part of the process of the economy slowing down, of people with less stimulus money or no stimulus money at this point. So that is another reminder that the Fed is, in fact, slowing the economy down. The economy is just slowing down, period, because it ran out of momentum. Is it enough to say we're in a recession? Not quite yet. The big layoff announcements seem to be coming out of big tech. I don't think that's enough to really crush labor, but we'll have to see if companies like Nordstrom and Macy's and other companies start announcing layoffs. Then you're going to start to realize that, tech companies are not Main Street, okay? But other companies like big retailers, that is Main Street, and that would affect how the markets will react to a rise in unemployment. Okay. By the way, a rise in unemployment in the financial markets would be considered good because it means the Fed could ease off raising rates. It could pause raising rates, then it could pivot, cut rates, and that could be good for financial markets. And I hate to say it, but a lot, if you're really in financial markets, bad news is good news. So I'd rather have good news, though. I know. Okay. So let's talk about the big stock after Let's just take a quick look, though, at Nordstrom. Pop myself up in the corner. Let me just take away those, the social media icons. So Nordstrom, JWN on the New York Stock Exchange was down 13 cents in the regular trading. It was a down day in the street yesterday. It was a big down day yesterday, and it's down over $1. That's a lot for a $16, $17 stock, down 6.42% after market trading. Let's look at Netflix, okay? Netflix misses on earnings, but blows away estimates on subscriber growth. So Netflix is shooting higher in the aftermarket. It's up $20, up over 6%. And even though revenues were so-so, earnings were not as good as expected, Netflix is shooting higher because it's about subscribership growth. If it's a growth company, then earnings be damn, you want subscribers. They've delivered on that. I think that's a good thing, and that'll probably give a lift to the rest of the high flyer, I'm doing air quotes, high flyer, big NASDAQ companies. All right, so that is a big news there. Let's take a quick gander at the S&P 500. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index, okay? But, last week we had euphoria. The markets were all set for a good year. The Fed's going to pivot soon. Inflation figures, the CPI, the Consumer Price Index, the Producer Price Index, they're going down. Purchasing managers indexes for a lot of regions of the United States are starting to weaken, especially the New York region, the Atlanta region, the Philadelphia region. But yet now the S&P is only up 1.55%. Last week it was up 3.5%. So we are giving back the year's gains very quickly, and we're barely up this year. I know the year is young, but we are all trying to get a handle on where we think this year could end. Overall, though, Dow down 252 points, NASDAQ down over 100 points, S&P down 30 points. That's 0.75%. Gold is continuing to hang in there above 1900. Oil is in the 80s again. U.S. Treasuries yields went up ever so slight, but they've been coming down a lot lately, so no big deal. And the VIX continues to hover around 20. What does all that mean? It means yesterday's really big down day was biggest down day in, I think, since October in the Dow. Today it's followed up with another big day, another down day. So the trend has reversed. We started to see an uptrend. Now we're seeing a downtrend, and nobody knows which way things are going. Because last week we thought we were in a trend up. 50% of all stocks in the S&P 500 were above their 200 moving day average. You know, speculative assets were starting to go up, which means people's feeling animal spirits for being aggressive were starting to come back. So Bitcoin was going up. Small caps were going up, but that's reversed this week. So we're just trying to find a direction, and that's the key of 2023 so far. It's completely directionless. Last week, the Fed's going to pivot. This week, the Fed's going to raise more. Lael Brand, Vice Chair of the Federal Reserve, said, we still see higher rates despite inflation coming down. That means they're raising rates higher. Jamie Dimon, CEO of JP Morgan, said at the World Economic Forum in Davos, Switzerland this morning, he sees rates going above 5% in the Fed funds rate and short-term rates in general. And he says, listen, inflation's coming down, but we're a long way from getting to the Fed's target of about 2%. He said inflation is well entrenched. It's everywhere. It's spread everywhere. And he said, basically, I don't think people really appreciate how entrenched inflation is, and it's going to take a lot more pain to get rid of it. So he's a pretty smart guy, right? I mean, probably the smartest guy in financial services. So if he says that, I think you have to take him at his word. Bank of America's CEO, Brian Moynihan, said that their base case is a shallow recession this year. Okay, so let's take a look at yields. We're almost done here, guys. Yields were up across the board, ever so slight, but you're still getting 4.7 for 4 months, 4.8 for a 6-month T-bill. I mean, people talk about CDs, but when you could get almost 4.8 and change on a 6-month Treasury that is also free from state income taxes, guaranteed. That's a good deal, in my opinion, if you're looking for a short-term place to get some good yield. If you have money that you're not going to need for 6 months or longer, this could be a good place for it. Could. Speak with your financial advisor before making a move. And, if you want to talk to me about that, you're always welcome to reach out, and we could have a nice, intelligent conversation about that and see if it's the right thing for you. Having said that, I don't like to give general, broad recommendations on the live stream because I don't really know the situation of everybody who's watching. All right. So having said all that, what else do I want to talk about? One more thing. This. Hitting your own debt ceiling, what a maxed out car does to your credit score. I've talked about personal credit limits and what goes into your credit score many times on the show, and I've made some content about that. But let's look at it like this. When you have a credit score, okay? FICO, the Fair Isaacs Corporation, is who determines your credit score. That's what we call it, the FICO score, by the way, for Fair Isaac Company. So one of the things that affects your credit score is credit utilization. So think of it this way. If you have a credit card with a $10,000 credit limit on it, and you borrow $10,000 on that credit card, you've reached the maximum of your credit utilization. The credit rating agencies, they don't like that. That lowers your credit score. They typically want to see your credit utilization rate really at 0, but 30% and under is okay. When you get above 30%, that's when your credit score starts to become affected. So how do you lower your credit utilization rate without paying down your debt? I mean, paying down your debt would be the best thing to do. But I think people who are carrying credit card debt balances, what you don't read in the articles is these are people who don't have the money to actually pay down their debt. That's why they're carrying a credit card debt balance anyway. All right. So, I mean, you read all these articles. What you should do in 2023 to get your finances in order is first pay down high interest debt. And I see these articles all the time, and I'm like, it's so stupid. People are carrying this debt because they don't have the money to do it. If they did have the money, they wouldn't be in credit card debt. You know, it's so easy to give advice like, I'm going to give sensible advice, but you have to realize who you're talking to. Okay. If everybody could just pay down their debt, we wouldn't have anything called bankruptcy in this country, right? All right, let me get off that horse there and say this. You could actually ask the credit card company to raise your credit limit. They might not do it, especially if you're exceeding 30% of your credit limit on your credit card. But if they could do that, let's say you have a $5,000 debt with a $5,000 credit limit, all right, and the credit card company raises it to $10,000, your credit limit. Now your credit utilization has gone from 100% to 50% on that credit card. That's good for your credit score. It's also good for, it's good for your credit score. Let's leave it at that. What about opening up a new credit card with a new credit limit and you don't use it? Well, you're not utilizing that credit, so it's a low utilization score. But one of the things that affects your credit score is how new your credit lines are. So a new credit line, opening up new credit lines, that actually hurts your credit score until they get old. But if you start opening up new credit cards, you're going to be looked at as someone who's about to get into a lot more debt, who's going to start really living on credit cards. So that actually lowers your credit limit. So it's a little tricky. But the best thing is take your time, pick your spots, do the best you can. We would all love to pay down our credit card debt if you have it really fast, but sometimes you can't. Don't stress about it. Just come up with a plan, even if it's just a little bit every month of lowering your credit, not just paying your credit about your minimum payment, but a little bit extra on top of that. If you could consistently do that, you will be in good shape. If you can't, and you're really just flat out broke, you've got bigger problems than your credit score. And at that point, you may have to speak with another kind of professional, maybe an attorney, to help you get out of it. This is not legal advice. I'm just saying, if you're in dire straits and you can't get out of it, you have to do what you have to do. All right. So anyway, I am going to end the show now. I thank you so much for joining us. And if you think of anything else that you'd like to ask, let me know. And I will definitely see it in the comments. And that's it for the week. Oh, real quick, I'm starting a new radio show on Monday. It's called Money in the Morning with Mitch Goldberg on 103.9 FM here on Long Island. It's on a radio station called Long Island News. It's obviously you're not going to get it if you're not on Long Island, but you could listen to it on their website, and I'll be streaming it right here on Facebook, LinkedIn, YouTube, and Twitter. So you'll definitely be able to catch me live, not once, but twice a day. And I'm really looking forward to it. All right. Take care, guys. See you soon.